expect rates to come down in the US to around 3% by the middle of next year. And that, coupled with ongoing economic growth, some moderation in the dollar, is a reasonably good setup, I think, for risk assets and equities in general. You're right that tech stocks have continued to dominate the US market. They make up almost 40% of that index, and they've done well. But let's not forget, this year is a year where diversification has really worked. Yes. This US stock market has actually underperformed most other equity markets, including the UK. And many of these other markets, like the UK, don't have any or very little tech exposure. Yeah. So you are seeing this broadening out. I think that will continue. Aggregate upside, I think, is limited because valuations are reasonably high. But we're going to get profit and dividend growth, and that should really drive equities.
Our take is bullish. We have been bullish just for the sake if the year is turning. Should we change? No, I think the cocktail of events that we have in America is still very solid. We think Fed cuts. We think they cut in December. They cut in April. It's absolutely unfinished business on the rate cuts. The two big macro events that we are watching. One, for sure, there's midterm elections, and then you have the Fed, change in leadership in the Fed. And I think this particular event, change in leadership, will get way more focus for currencies, for equities, for the rates. Whether terminal rates needs to be shifted, lower than where it is today. I think all of that comes into a big question mark.
I don't think things are a done deal at this point. I suspect there probably will be a cut in December. That may be the last cut that we see from the Powell Fed, right? So just because you get in December doesn't mean we're like opening the gates for a whole set of cuts. But I think we are in all likelihood going to see more dissents, 4 dissents, maybe 5 dissents, which has not happened in quite some time with the Fed. I don't think that's a sign of a problem. I think it's a sign of there legitimately are reasons for the Fed to be conflicted. Inflation is still well above 2%, has been for years. There are still price pressures. The Beige Book talks about those costs that are still out there with businesses that could end up coming to consumers. And we have a labor market that, while it's slow, there's some signs of faltering, it's not going over a cliff at the moment.
I think it's more that we should expect to see continued volatility. If you think of what a difference a week makes, right? Last week, there was a lot of concern that the Fed actually won't cut rates in December. And now this week, as we started to see more consumer survey reports come out, we started to see Mary Daly, the San Francisco Fed governor, speak to her concerns around employment and potential job losses and weakening in the employment market. All of a sudden, that expectation for December rate cut is back on, and we see markets have really recovered so much this week.